Right, we now speak to ratings agency Standard & Poor about South Africa's credit outlook following the budget speech tabled by Finance Minister Tito Mboweni. The agency has been concerned about the country's low economic growth, debt levels, and the state of our state-owned entities. I'm joined now by Sovereign Analyst at S&P's Emerging Market Ratings, Mr. Tatonga Rusike. Tatonga, thanks so much for joining us this evening. Tell me, did Minister Tito Mboweni's budget speech yesterday move you in any significant way?
Well, thank you for inviting us. It's a pleasure to come and speak with you and the viewers. Look, I think we need to give it a context. And the context is if you compare the numbers in the budget yesterday compared to the MTBPS, the numbers are slightly better. You're looking at, let's say, slightly less fiscal deficits and perhaps lower increase in the debt to GDP trajectory, as well as perhaps better economic growth numbers. But I think broadly speaking, they are coming from a very weak level. So yes, there are some improvements, but there are still risks to the projections that were presented yesterday.
S&P were one of the first to actually downgrade us further into junk during the COVID-19 pandemic, and lots of people have been asking, was that necessary? Was it unavoidable?
Well, you will remember that 3 years ago, I think South Africa's debt to GDP was probably around 50% of GDP. And today we're talking about debt around 80% of GDP. So I think since then you've also seen fiscal deficits. At the time in 2017, we're also around 4% of GDP. And this fiscal year, we're talking about double-digit fiscal deficit, and then perhaps slightly coming down into high single digits before we can even talk about deficits coming below 5%. Of GDP. So I think things have been tough for South Africa over the last few years. They remain tough. I think tough decisions still need to be made. South Africa entered the pandemic in very weak economic situation as well as public finances. So even tougher decisions need to be made. So I think as far as we're concerned, ratings came down since 2017. And as of now, the foreign currency rating is now at about BB- with a stable outlook. So that's where we are. I think we're observing what choices are made and what those means for the ratings going ahead.
In your interactions with government, I know that you often like to engage with them during these times. Do you feel like the government is hearing what you're asking of them to do and they're actually taking this seriously and implementing?
It's actually the other way around. Us hearing what the government is saying that they would like to do, not us telling the government what to do. I think I picked up on the earlier conversation about, I think one of the agencies calling for reforms, just to put it into context that credit rating agencies do not ask governments policy actions to take, but the point is to opine on likely decisions or decisions taken by governments and what they mean for ratings. So I think there have been things in the pipeline from the government side as far as reforms are concerned. I think more recently now, we have a package of reforms in the name of Vulindlela, among other things, perhaps that can help spur growth. At the moment, I think South Africa has benefited from some of the global activity with higher commodity prices and also issues around containing the second wave of the pandemic. Economic activity has also increased, which helped the public finances, or at least government, to collect more tax revenue than they anticipated in the budget document, or at least in the MTBPS last October. So ours is to see what the government says and whether we think these targets are achievable, and if they are achievable, what would they mean for the rating and the outlook.
What would they mean for the rating and the outlook? I know that you have a ratings outlook coming up soon. Do we expect us to remain stable, or is there a downgrade in our forecast?
Yeah, well, I think for us as S&P, you may recall that we last published our report in November, which was after the presentation of the MTBPS numbers. We maintained the rating and the outlook with the MTBPS numbers. So I think broadly speaking, yes, they are slightly better, but they remain in the same kind of ballpark. where you still have, broadly speaking, weak economic growth and weak public finances. In order for ratings to go up, you're going to need, I think, much higher economic performance over the medium term, and also getting to stabilize that debt to GDP, at least in the medium term. At least the Treasury forecast is for perhaps for 2025. There are still risks to that. So before you get to stabilize debt, I think it's unlikely that there would be suggestions of ratings going up. As well, I think with the budget presentations from yesterday, it suggests that perhaps as far as the public finances are concerned and the economic outlook is still more or less in the same ballpark. But there are also other factors that come into making rating decisions, such as the external sector analysis, the monetary sector as well. So there are other factors that come in. So, I mean, it's not, the budget in itself is not complete to making a final outcome on what may happen in the future. But as far as public finance are concerned, they're still in the same ballpark.
All right, that was the sovereign analyst at Standard & Poor's Emerging Market Ratings, Tatonga Rusike, giving us Standard & Poor's view, drawing quite a hard line. We should wait to see what happens in the near future.